Hi guys, good afternoon. Arun Juyal here. I again welcome you to my YouTube channel. I am a mutual fund distributor based in Rishikesh, and I try to make a video every day based on new topics. And I really want to thank you for all the love and support you have shown me. If you have any queries or questions, or if you feel there is any topic that you want me to make a video, I'll do that. Please write to me. And the topic for today is that why high returns are overrated. Well, I want to start off by saying that we do invest in funds by thinking that we'll get more return than FD or uh, say debt products, and there is that is fair enough point. But the problem arises when people think about chasing returns. I've made few videos about that earlier as well. But when you try to chase returns, then you forget about risk, and it hurts your bottom line more often than not. So never try to chase returns. I'll break down in 5 points. As always, the first is that high returns comes with high volatility. You have to keep in your mind that whenever you are seeking high returns, there is an element of higher risk. You can't ignore that. Say, for example, if you're thinking that this Bitcoin has given this kind of return, then you need to understand that there is a huge risk involved with that as well. You can't invest your life savings in Bitcoin or such assets which are highly volatile. So you have to keep that in your mind. Second point is that behavior decides more about your wealth than numbers. A 12% return from a mutual fund is far better than a 20 plus return from an instrument which is newer, which is riskier. There is no regularity. You have to keep that in mind. Third is that the risk increases faster than returns. Well, you need to understand that making money is not easy at all. And if you think that you can beat the market, you can. If you think that you are smarter enough than a lot of people, then you may hurt yourself more. You need to keep that in mind. And remember, wealth is built by earning reasonable return over a longer period of time, not a good return in a shorter period of time. Fourth point is that consistency compound better than brilliance. You have to keep that in your mind that there is no shortcut, there is no uh, replica of consistency. I always say that you have to spend more time in the market rather than thinking about timing the market. And mind you, if you can do that, then you will do wonders for yourself, for your financial health. Fifth point is that staying invested is the real real important thing now. The biggest return comes from staying invested for the longest time. You have to stay invested for as long as you can, and mind you, with a 12% CAGR, your 1 rupee will become 4,900 in 79 years. That is the power of compounding. So just think about that. Think about staying invested for a longer run. Market will give its due to you. You need not to chase returns. And high returns look good on paper, but it is very difficult to get them. Uh, I give you an example of Bitcoin, and you need to understand that. So I'll repeat the points once again that you need to understand that high return comes with high volatility, and, and volatility can hurt you more than giving you returns. The second point is that behavior decides more than number. Your behavior should be intact, should be about consistency. Third is that risk increases with higher returns, and people lose more when they chase returns. The population is more of people who are losing. Fourth is that consistency compound better than brilliance. You need to be consistent rather than thinking about being brilliant. And the fifth point is that staying invested is the real thing. Staying invested for the longer run. You need to understand. You need to stay invested for as long as you can. Think about it. as you will not withdraw that. You will only redeem when your goal is achieved. You'll do wonders in the market, in mutual funds. And if you have any queries or questions, do write to me. Thank you very much. Have a great day. Bye. Cheers.